We are live and ready to go. This is a little different. This time we actually have Harley sitting in his office, and I am being joined in Miami at an event called The Collective with Corey Hoffstein. Corey, welcome. Good to see you.
Thank you for having me.
So we're going to sit next to each other. We're going to try to talk into a laptop. We're actually talking into one of those owl video conferencing things, this is actually an interesting experience. Brian, we're going to talk about the role of luck and rebalancing. Harley, I know that luck plays no role from your perspective, but are you prepared to discuss this with us?
My entire career is based on luck.
There we go. That sounds great. Okay. So before we kick in, one of the ways we always start this is with a series of polls. Jimmy, do you want to...
Mike, hold on a second. Before we get started, a couple housekeeping items. And then for everyone who may not know, Corey Hoffstein is a co-founder and CEO of Newfound Research, which is a quantitative investment and research firm that offers investment solutions like structural alpha model portfolios. Information on these and other strategies can be found at thinknewfound.com. Corey and his wonderful wife, Lauren, are weeks away from welcoming their first child into the world. And in the meantime, Corey is the proud father of 2 new ETFs, the tickers of which I can't mention because of compliance, but exciting that they listed yesterday. And then, of course, 2 people who are not expecting children, Convexity Maven, Harley Bassman, and Michael Green. For those of you who want to ask questions, there is a Q&A button down at the bottom of the screen. It says Q&A. So send your questions in there, and we will try and answer them in real time or incorporate them into the conversation. As always, this conversation is meant to be entertaining. It is meant to be educational. It is not meant to be taken as investment advice. So, Mike, take it away.
Fantastic. And I just want to emphasize, nor is it meant to be particularly useful. So, Corey, we are sitting down here. We've been spending the day basically hanging out in the sun and discussing the future of the world, the opportunities. And I will tell you that we've actually got a couple of people here who are deep into the technology stack. We're all screwed, is I guess the easiest way I would put this.
That is what I learned this morning.
Yeah.
Give up.
So giving up is definitely on the agenda. But before we do that, let's try to adopt a predictive algorithm called our audience. And let's ask a couple of questions on a survey that might actually be of interest to us as we go through. Jimmy, you want to put up the first question? Okay. Best hedges for 2023 and the rest of the year. Given the reversal that we saw today, it certainly was interesting. Feels like there might be a little bit of a change in the air. Market has been feeling a little bit heavy to me. So do we think the best hedges for the rest of 2023 are S&P puts, VIX calls, duration, or we don't need no stinking hedges?
Mike, are we missing one particular hedge that, might be interesting?
So that would be the anti-duration. Harley, can you, would that be your choice on this?
Definitely.
Definitely. Okay. All right. And then the second question we have is inflation for the remainder of 2023. We're putting this here for Harley. Answers are, we'll see deflation before we see a return of inflation. Watch out, commodities are breaking higher. Or 3, stretch your imagination, hyperinflation is just around the corner. And we're told the hosts and panelists can't vote. But we know where Harley's voting. He's voting with a negative duration hedge. And by the way, at the Collective, we are drinking coconut waters with rum. So both Corey and I are ahead of the game on.
Yeah, the conversation will be a lot more interesting in an hour.
Exactly. Okay, you can close that. All right, Jimmy, are we going to get our responses? Perfect. There we go. Oh, look at that. We're widely distributed. So 47% S&P puts, 19% VIX calls, 22% in duration, and 12% is not the least bit concerned. Interesting. We are almost we have a live studio audience here at the Collective. I just got a reverb announcement. Actually, the inflation is quite interesting to me that we split almost exactly down the middle, and it looks like not a single vote for hyperinflation. So I think we're at least a little bit okay there.
Yep.
Okay.
That's a good sign.
All right. So the reason we brought Corey on is because Corey has actually written a paper that we're going to flash to some slides from Corey, a couple of years ago, you wrote a paper called Return Stacking that highlighted this idea of how to build portfolios in terms of using leverage. That has played a key role in the way we think about opportunities at Simplify, certainly influenced us. Before that, after that, I guess you wrote a piece that was highlighting the dynamics of liquidity cascades that began to hit on some of the changing market structure stuff that I've obviously been intimately involved with. Your work was fantastic there, and among other things, introduced a lot more people to things like Gabe and Koigen, et cetera. Now you've come out with a third paper in as many years. This one is co-authored with Roni Israelov, used to be from AQR, also a friend of mine as well. The paper is basically about the idea of how does your rebalancing frequency or rebalancing dates factor into the return profiles that we get. Could you add just a little bit to that? What was the genesis behind this? How did you think about this, et cetera?
Absolutely. Look, this is a topic that I have been discussing and writing about for the better part of a decade. I often feel a little bit like Don Quixote tilting at windmills. I keep screaming that this is an important subject for people to consider in their portfolios, but it's not the sexiest subject to talk about. So where I wanted to start was actually with a bit of a story, maybe try to get a little hook to get people interested into why you should care about this. So I want to rewind the clock back to 2005. Rob Arnott from Research Affiliates, right before the inception of Research Affiliates, really wrote a paper on fundamental indexing. Now, the idea of fundamental indexing is really just a rebranding of value investing. But in that paper, they basically took US equities, weighted them by their fundamental characteristic, and rebalanced them every March. They published that paper, I believe it was in the Journal of Portfolio Management, and went on to launch products that would track this concept of a fundamental index. Come 2008 into 2009, they ended up outperforming the S&P 500 by 1,000 basis points with this strategy, arguably launching Research Affiliates into the monster it is today. A couple of years later in 2010, some researchers from Robeco ended up writing a paper that asked the simple question: when we look at this fundamental index that Rob Arnott proposed, he proposed that it would rebalance in March. But that seems like an arbitrary decision. Why not rebalance in December? Why not rebalance in September? And so what they did is they constructed the hypothetical alternatives. They said, we're going to take the exact same rules that Rob proposes, but we're going to run them at a different time of the year. And by running them at a different time of the year, following the same rules, we might end up with a slightly different portfolio. And does that ultimately affect the returns? And what they found, one of the most glaring examples, was that in 2009, the version that Rob actually ran, that rebalance in March, that beat the index by 1,000 basis points, if Rob had chosen instead to arbitrarily rebalance it in September, it would have underperformed the market.
Now, wait a second. So you're saying that the exact same approach, just changing the initiation and rebalance dates, would have had radically different performance. Well, why not just run it on? I mean, this is running it. How frequently are we rebalancing? In these
so this strategy, and there are other major indices that do this exact same thing, was at that time rebalancing once a year.
Okay.
And so you can understand why this, in certain circles, became known as the immaculate rebalance, right? This ended up being the rebalance that launched a firm that arguably was based entirely on the fact that the crisis of 2008 ended in March 2009. If it had ended in September 2009 or December 2008, the entire history of Research Affiliates could have been entirely different.
Now, do you actually think what this was exposing, that there was a data mining is not the right term that I'm looking for, but effectively, was there a component there that it was designed in this way? Or do you think that the strategies, like it was pure luck that this happened?
Yeah, so I have come to term this as rebalance timing luck. And I don't think that this was strategic, though I think it's been interesting. We've seen, it was March 2009, it was March 2020. It certainly seems like March rebalancing has gotten lucky a couple of times over the last decade. But what you find is that this concept of rebalancing at a very particular time, affecting the composition and therefore the returns of the portfolio, shows up everywhere. And it shows up when you're rebalancing your strategic asset allocation. Lots of advisors we talk to might rebalance their clients at year end. The performance for those clients might be very different if it was rebalanced in the middle of the year. Lots of smart beta products that have been launched over the last decade, factor ETFs, rebalanced twice a year, maybe June and December. Well, what would happen if it was March and September? As it turns out, if you go back and you calculate that counterfactual, the returns are very different. And it certainly affects option-based strategies where you might have, say, a quarterly reset. Well, what if instead of resetting every January, March, June, you just offset that by a month, right?
Now, this is one of the things, so I interpreted this slightly differently. And for you, the, tilting at windmills was focused around the dynamics of rebalancing luck and the role that that played. You referred to something just now that I think is actually really important, which is we see this all the time in option strategies. Effectively, there's path dependency that is created there. It's one of the reasons why I wrote a paper talking about, talking your book about value that highlighted my interpretation of value investing, and certainly smart beta and factor-based or fundamentally weighted indices have this characteristic. What you're really doing within those strategies is that you are setting a preset dynamic in terms of what's going to cause you to sell something, what's going to cause you to buy something. So a fundamentally rebalanced index, by definition, the fundamentals are going to change very slowly. The price is going to change fairly rapidly. That leads to those strategies functionally becoming a pre-agreed set of options, right? I will sell stuff that goes up more than the market. I will buy stuff that goes down. In other words, I'm just short options in that structure. And that does seem to explain a lot of the premium associated with these types of strategies. And your work in terms of the rebalancing luck or the timing luck that came from Robeco, and then ultimately you've extended it, certainly suggests that.
Yeah, I think what I hope my research suggests is that there's a tremendous amount of path dependency in the when, and right, and that optionality has a tremendous amount of path dependency
Correct.
associated with it. So that certainly could be one of the answers here. One of the things I really want to stress, because when I initially talk about this subject, what a lot of people say is, well, we would expect it to revert, right? If it's all luck, you expect it to revert. And that's not really how luck works, right? If you get lucky, you don't necessarily eventually get unlucky in an offsetting way. What happens if you study this from a statistical perspective is that these are one-time random permanent impacts in the track record of these strategies. So again, not to name names or pick on firms, but one of the ETFs that was out at the time that Research Affiliates was powering, just if people want to go look at this, and you can look at its performance relative to the S&P, and you'll see that there was this big jump in relative performance in 2009. And then it looks more or less like how value funds have looked over the last decade. It hasn't, done outstandingly well on a relative basis because it has a value tilt, but right, they're able to lean into that alpha from 2009 permanently in their track record. And so understanding the source of returns, right? If all of our jobs are to pick managers, understanding the source of returns and what's luck and what's skill, not only in the managers, but in our benchmarks is incredibly important.
Now, one of the ways, and I'm going to share some slides here to kick off on this. So give me 1 second here. And is that showing up properly on our screen?
No, not yet.
Not on yours. Okay, so let me stop share. We'll try one more time. And now we will go to share screen again. Well, you know what? I hate Apple computers. I've already announced this twice. Let's see, there it is. And my mouse is now no longer active. Where did it go?
It's there, it's just not
Corey,
moving.
while Mike is playing around, and we're going to get to a number of your slides, hopefully. What's not going to help you is this. Let's agree that there are various anomalies in the market that are created by accounting or by regulation or by whatever it might be. And it makes sense to go rebalance on January 1st or December 1st, December 31st. That kind of makes sense. Are these sorts of things stable and consistent? So like a Renaissance technology that come in there and make money on that? Or are these things always moving around? I get the idea if you have, as you described, a Renaissance RA, they got lucky 1 year and then they could carry that, for a decade. But if you pull that one day out, then there wasn't that much value to it. Are these things stable or do they keep moving around over time?
Yeah, so what I found in my research, right, I think there's sort of two parts of your question. One is with things like rebalance timing, like someone like Research Affiliates, do you find that there is a stable anomaly that can be mined out by a particular rebalance date? The answer largely depends on whether you believe there are seasonality factors or edges, right? For a lot of these strategies that I've looked into, there aren't necessarily strong edges that come from rebalancing on a certain date, right? There are sometimes minor edges, but what I've found is that the impact from this rebalance timing luck factor absolutely dwarfs the expected edge you would have. Now, I think another maybe subtle point you're making, Harley, is, can other people front run some of these strategies? Is that a potential impact when the rebalancing schedule of another, systematic strategy or an ETF? And that can absolutely happen. There are prop shops that try to front run the flow and the rebalance of a lot of these ETFs. Not really the area of study that I'm looking at here. Again, what I'm looking at really is, how does the time of when you rebalance impact the composition of your portfolio compared to how it might have looked had you rebalanced at another date?
So on that topic, go ahead, Harley.
Nope, go Mikey.
Okay, so one of the things that I've shared in some of the analysis I've done is looking at an example of this issue of taking the actual underlying return stream and just randomizing it and reassembling it. This is actually looking at the S&P 500, which is the bright red line that runs through this. That's the actual history of the S&P 500. And in order to create this chart, I took every single day in the S&P 500 and then just randomly reassorted it, right? So it's got all the same components. You'll notice that the beginning point and the end point for all experiences are identical. Now, in a lot of ways, this is actually what a fixed income security would look like, right? Because we know by a fixed income security what its beginning point and its end point is going to be. But the path between those, in this case, over something like 100 years, can be radically different. And in fact, you'll notice that one of the really interesting things that pops out is in the history of possible combinations, it actually turns out that the Great Depression was basically, the crash of 29 was basically the worst that could have actually happened given all the possible combinations. Now, that's not literally true if I were to run a nearly unlimited number of these, but you'll notice how extreme that is. And the other thing you'll notice is that this is exactly what Corey is effectively saying, that the exact same strategy produced literally a factor of almost 100 differential in some of these situations, right? So this is just the S&P, recombining it resulted in returns that would radically change any perception around the actual S&P itself. Now, what has been done, sorry, my mouse is working the opposite direction I'm used to. So the paper that you wrote, Corey, is hitting on this idea of the hidden cost in costless put spread collars. Where do you rebalance and time, right? So this is the actual link to the SSRN paper. Hopefully, I still can't figure that out. Okay, and what you're showing here is the compound excess returns for 3 different rebalance schedule implementations of a self-financing, i.e. zero cost put spread collar strategy. This is similar to strategies that we deploy in some situations, and certainly that others have done so at size. The obvious dynamic here is that we are selling a call, some strike out of the money, to finance typically a 5 to down 20% put spread. Is that correct?
That's exactly right. So these strategies, what you have here is they're buying the S&P 500 index underlying. So you're getting the total return of the S&P 500. And then every time they reset, they buy a put spread collar down 5% to 20. And then they are selling whatever call they need to at that point to make it a zero cost collar. And so what we have is 3 possible implementations. DMJS stands for December, March, June, and September. JAJO is January, April, July, October, and FMAN is February, May, August, November. And so those are 3 of many possible ways this could be implemented, right? But for quarterly reset strategies, These are sort of the three obvious potential implementations. And what we can see when we look at this graph is if you just happen to implement one of these, your performance could be wildly different than the rest. I don't want to name names of firms just so I don't get you and Harley in any trouble. But there are incredibly large strategies out there that have chosen to just implement one of these. And what I hope this chart shows is that there's a tremendous amount of path dependency and luck in that implementation that can lead to wild dispersion from alternative implementations from year to year and ultimately affect the amount of terminal wealth that you have. What I really want to stress here is the day-to-day, week-to-week, month-to-month, year-to-year volatility of these is almost all identical, but the amount of terminal wealth that you can end up with, depending on whether the rebalance timing you chose got lucky or unlucky, can lead to tens to hundreds of percentage points difference depending on how long you let the strategies run. They do not necessarily converge at the end.
So now we should make the point here that the January strategy, we can't say it's superior looking just at this chart, because if you started your this paper in 2015, that would look much worse, wouldn't it?
Exactly. You hit the nail on the head right there, Harley.
The seed you picked to start at is almost as lucky. Well, actually, I suspect that people, whenever they write a paper, they pick whatever they wanted to make it look good, which I'm not saying you did. I think the point you're making here is that the date makes a difference, which is important. But I don't want people to think that there's any kind of value in which one.
You hit the nail on the head. There's no magic to any of these. You certainly shouldn't walk away from this and say, oh, we data mined. Starting in January is the appropriate way to start. As you point out, Harley, if we were to plot the annual returns of these, you would see maybe January just got lucky in 2008. That was the perfect reset schedule and underperformed every other year, right? And so, but if you look at long-term equity curves and you make an investment decision based on long-term equity curves, you've been ultimately tricked by it getting lucky in some historical part of its equity curve.
Now, one of the things that I would highlight here is the question that was just raised by Mark Jacobs, which is this issue of how frequently should you rebalance, right? And I want to emphasize that that's actually not what you're trying to show here per se, although you do have some advice on that in terms of how to think about it. What we're really showing here is the path dependency, particularly as it relates to strategies that effectively embed option components, becomes really important. And just to illustrate this, we'll actually see this in a later slide, but you can think very simply about if you're buying a put spread and the market immediately falls, you're going to get much less response out of that put spread because of the value of the put that you've sold.
Right.
Right. Whereas if that same thing happens close to the end of the life of that option, you could move deeply into the money and that put basically is worthless. It's not subtracting from the top put at all.
Yeah, the easiest way to think about this is if you put the structure on day one, it's a 3-month structure. And even if the market goes nowhere, if implied vols go nowhere, by the day before you reset, it's a 0 DTE option, yep. Right? And those have very different behaviors and are going to respond to market changes very differently. And the volatility surface is going to respond to market changes very differently. To Mark's question, that is one of the first questions I often hear. Okay, how frequently should you rebalance? And that's actually a very different question, right? So ideally what you're doing when you're developing an active strategy is you are aligning your rebalance frequency with the decay of whatever alpha you're trying to pursue. So value investing, for example, you might actually want to buy and reset your portfolio on an annual basis to be in line with how quickly that alpha factor decays when you take transaction costs into effect. So the question is, okay, Corey, you're telling me we've elected to do a quarterly reset, whether that's right or wrong, I'm not making a call on. What I'm pointing out is when you reset is potentially a risk factor into the terminal wealth you're able to generate. What's the solution? Well, the solution is the same solution you get almost every time in finance. It's to diversify. I would argue what you should ultimately do is take a third of your capital and put it in each of these strategies so that you don't have that timing lock. So you're ultimately diversifying when you reset, and time becomes sort of another axis of diversification for you.
Well, it also, and so this is one of the charts that you're gonna, that we'll show here. So again, here we're highlighting the summary statistics. You'll notice, for example, that, the means can be dramatically different, right? As much as we're looking here at strategies that have as much to a point differential, the vols quite different, sharp ratios, quite different, et cetera. So this can actually have a huge impact on how you think about it. And I keep going the wrong direction. Cumulative return differentials. This is another one where it becomes quite interesting. One of the things that I'm always tracking is the ratio of two strategies versus each other. And I think that's actually really important because what you're highlighting here is exactly this path dependency, right? If you look to the point that Harley was making, if you happen to pick 2015 as a date, you would come to a very different conclusion than if you'd started some other point.
Exactly. What we really wanted to highlight with this graph is the magnitude of the dispersion, right? Tens of percentage points that can occur within a given year, but also the randomness, right? This isn't necessarily mean reverting. Some of these become permanent impacts over this time period. And again, when you start, can totally affect the outcome.
Right. And just to reemphasize that, if you imagine that by luck, you have a favorable event at the start and they are then identical after that point, that would be a preserved advantage that would lead you to conclude that somebody had been smarter along the process, right? Alpha had been created and yet it was truly pure luck. Okay, so
one more thing. Is this basically, proof of monkeys and darts for investing? Or is there some kind of ex-ante strategy that one can use over here? Like Mike, you always talk about, 401k investing and how that process works and how that could impact indexing. I'll tell you that 15 years ago, Merrill Lynch offered a product, institutional product, where you could buy the Goldman Sachs Commodity Index, and it would roll it would roll the whole book basically 3 days before the Goldman Sachs roll date. They had their data and it made money over many years. Like as long as Goldman, I guess, always rolled on the same date, you'd win. Is there an ex-ante way, or am I just stuck with throwing darts to get this thing right?
I'll let the master answer that one.
Yeah. So what I would say, Harley, is if you don't have an ex-ante way, right? If you don't have a strong opinion as to when you should be doing this, I would argue you should be diversifying your when, right? Now, I may feel strongly that the type of strategy I want to implement is a 12-month put spread collar because that's the horizon over which I want my protection, or I might think for whatever reason, 12-month puts are mispriced. The implied vol is too low and that's where I should be buying versus rolling 3-month. But that's not really something I'm trying to address. So that isn't to say people can't have and shouldn't express a view. If they have it, they should express it. But in this case, what I'm trying to say is without a view, right? If I don't have a view as to when I should be doing this, because I don't think there's a particular calendar benefit, or I don't think there's a particular tenor, right? Ultimately, what I want to do is diversify.
So one of the other things, and the question has come up, when you think about, if I'm reading this correctly, if we know that big players are crowding into stuff, or if we know that these are happening at particular dates, would that influence the way that you're thinking about it? Or because that feels to me like a structural implementation.
Yeah. So that, again, that goes back to the, do you have an ex-ante belief, right? So there is obviously a very large fund that does something like this, tens of billions of dollars. There's been a lot of discussion about market impact of their rebalance. Is it something that can be front run? If you felt like that particular implementation was going to have negative alpha, one of the things you could do is you could still utilize that implementation because it might still have beneficial diversification benefits, but you might just weight it a little less. So you might, let's say we had the 3, instead of being 1/3, 1/3, 1/3, right? You might take it down to 1/6, right? And that all is going to heavily depend on your view of its relative expected returns to the other implementations. But, without a view, ex ante, you would say, well, all 3 implementations should have the same expected return. They're all the same strategy. And if I don't believe that rebalancing at a certain time in the year has an edge, they must have the same ex ante properties. And therefore, I'd want to diversify equally across them.
Right. And so the next question actually is a variant of that, which is saying, this is very specific to what strategy you're running with momentum. To minimize this, you have to rebalance more often versus a value strategy. If it was a totally different asset class, how frequently would you be rebalancing? It's similar to the question Mark was asking. Again, you're basically saying, if you're using 3-month options, you want to rebalance quarterly. If you're using 1-year options, you probably want to think in a rebalance on an annual basis. That would be similar to something like a value long short strategy, where the historical data suggests it takes time to converge. There's little value, quote unquote, in rebalancing a value strategy monthly, weekly, daily. The point was raised about 0 data expiry options, right? And the charts that are up on the screen right now, and I'm going to lower this down, and I apologize in advance that we're having some challenges on the presentation side, so hopefully this came through properly. But if you notice the chart on the left, this is actually highlighting the path dependency of option-based strategies on the return profile over time. Can you highlight exactly what's going on here with the chart on the left, and I'll try and clear up some screen.
I was going to say, can we move some windows here?
Yeah.
So what we're showing here in this graph on the left is the delta profile for each strategy on a given date. So what we've done is we've looked at on February 14th, 2019, totally randomly selected date. We plotted the delta profile of each strategy. Right, and you can, again, the delta profile, for those of you who aren't speaking the Greeks fluently, is going to give you the sensitivity of the strategy to changes in the underlying, in this case, the S&P. And what you can see is that these deltas are incredibly different. So depending upon where the S&P moves to, one of these strategies in the dark black is going to have significantly more sensitivity, and it's going to have a very binary outcome, largely driven by the fact that it is very close to expiration, versus the other implementations have much more moderated sensitivity. That's because they are further from expiration. But you can also see that the humps are slightly at different points, and that's because when they were struck, the market was higher or lower than when the other strategies were struck. So this difference in delta between the strategies on any given day is a large driver of their relative performance difference.
One of the other things that becomes kind of clear here is you also see elements of, I wouldn't exactly describe it as phase shifts, but when you combine across multiple strategies. And so when we think about a hedged equity strategy that has incorporated the insights that you've provided here, the way we choose to implement our hedged equity strategy is by doing a series of rolling exposures. So we actually combine exactly this approach where we are taking 3 separate time periods and rolling across them so that at any point in time, at least 1/3 of the portfolio exhibits this very strong response that you're highlighting. All right, that tends to create a much smoother portfolio implementation overall, and takes advantage. This goes back to the question of kind of like, what are you actually trying to do here? It's effectively like dollar cost averaging, right?
Absolutely.
You're smoothing out your entries, you're smoothing out the response, and you should benefit from the volatility drag associated with the strategy relative to other implementations.
I think a really concrete example for people to consider is that once every 4 years, we have a big event in the United States called the election.
Right.
It happens every November. Now, let's say you had an implementation that had an expiration of this structure in October. So you reset it in October, and now all of a sudden you're holding 3-month options, but the price reset pretty close to when the election took place. Versus you have a structure that is going to reset in November. Well, by the time the election comes around, that November structure is very close to expiration, is going to likely be very sensitive to price changes around that event, versus the structure that just reset. You're talking about 3-month options, going to be a lot less sensitive and likely provide you a lot less protection. And so again, that is totally arbitrary and random. And, we have the schedule of events like elections, but there's plenty of geopolitical events that happen at a totally random time. And so by only choosing one of these implementations, by not sort of dollar cost averaging over time in your implementation, you end up being sort of very randomly sensitive to the goings on in the world.
This also has a little bit of a clue on one of the market features and experiences that we've had recently, things like the popularity of zero data expiry options. And some of the work I've done and others have done has highlighted that these options appear to be net sold, right? That this appears to be much more of an income generation. Why would you link that with what we're seeing here?
That's a good question. You're teeing me up for something. You clearly have something
Yeah.
in mind, but I'm not sure I'm following where you're going.
So the easiest way I would think about it is when you start selling options, you're moving to strategies that have high positive expectancy in terms of the frequency of wins, right? But they have severe adverse consequences of being wrong, right? So I would expect to win when I sell options something like 85% of the time, may not be exactly that. But the more frequently I engage in that with smaller sums on each individual bet, the more probabilistic and stable that strategy becomes, at least in a back test. Right now, I
Right.
certainly am exposed to out of sample errors in terms of that frequency of 85% and the risk that the market actually begins to respond to the positions that I'm putting in place. But that would be a really clear articulation of why you would want to shorten up the time horizon, particularly when you're net selling options. You're actually, interestingly enough, reducing your exposure to any one individual day, event, et cetera.
Right. Well, and again, that has to do with that predetermined selection of your rebalance frequency. This research is once you've made that decision, what is the schedule? So I see a question here talking about just asset allocation, which is what I wrote one of my first papers about. And Vanguard just came out with a study that showed that once you take transaction costs into effect, the optimal rebalance schedule is annual. Now, what I would argue in my research is that if you're interpreting that as to say you should rebalance once a year, well, again, you're going to have a huge amount of dispersion in your performance relative to someone who chooses to rebalance at a different point in the year. What my research suggests and what I would say with full emphasis is that what you should be doing if you're going to do it once a year is do it a little bit infrequently. So you might choose to rebalance 1/12 of your portfolio every month. And in doing so, what you can really think of that as is you're taking 1/12 of your portfolio and putting it in a strategy that rebalances once a year. And then you've got another 12th of your portfolio that rebalances in February and another 12th that rebalances in March. And in doing so, you're diversifying that risk of when, while still being optimal to the research that says, well, you should rebalance once a year because that's going to get you all the benefits while minimizing the cost.
And I just want to reemphasize, we're not actually suggesting that you can, because the question has been raised about timing. The question has been raised about, could you, for example, enter these types of strategies when implied is moved above realized or realized is moved below implied? Those would indicate, market timing to try to maximize the alpha associated with it. And there certainly can be implementations that try to do that. This is doing something different. This is actually saying, we're looking at the pure factor of luck and the path dependency associated with it. And since that is outside of our control, I don't know how to manufacture luck. I wish I did. But what you're actually saying is let's take as much of the luck out of the equation as we possibly can.
Right. So you look at a classic benchmark like the SIBO buy right benchmark that is going to sell an out of the money call option once a month. And they're doing that. I believe that's a third Friday expiration that they're doing it. Well, it's hard to backtest the counterfactual of what would happen if they did it on a second Friday, first Friday, because those options haven't historically existed, but going forward, they will. And so the question becomes, well, if you're doing it once a month, why are you doing it on the third Friday? Well, historically you had to, but why aren't you doing maybe 1/4 of the selling on the first Friday, 1/4 on the second, 1/4 on the third, 1/4 on the fourth, right? And in doing so, again, you're diversifying that potential timing luck. But just being aware that all of those indices, which managers are benchmarked to, have substantial luck embedded within them, right? I think is an important consideration to understanding whether managers are exhibiting or not exhibiting alpha.
Well, and for me, one of the things that I love about this is it does indicate that there are ways that you can take the exact same strategy, at least in terms of its theoretical implementation, and reduce the risk of those factors or that timing dynamic, effectively creating a more technically accurate or a diversified exposure to the true factor as compared to an individual market event like elections,
Exactly.
like COVID, et cetera.
Again, go back, imagine yourself back in 2005, you read Rob Arnott's paper and you say, this is brilliant. I'm going to implement this exact strategy, but I'm going to do it in September. And Rob Arnott comes out of 2009 and outperforms the market by 10 percentage points, and you've underperformed. You are going out of business. Rob Arnott is building $1 billion personal net worth. And it has nothing to do with the quality of the strategy. It has everything to do with he got lucky as to when he rebalanced. It can literally be the difference between hired and fired in our industry.
And it can absolutely be the difference between hired and fired. It can absolutely be the difference between a product working and not working. And again, this is not actually in any way, shape, or form trying to subtract from the theoretical construction of a fundamental index or a value weighted index or even a zero cost collar index that happens to have a different implementation. We're just highlighting that there are steps that can be taken to technically improve the probability of success.
Well, the part of the story I didn't add where that should really finish it is research affiliates went, oh, you're right. This is a big risk. And they implemented something called staggered or tranched rebalancing, where they take a little bit of their portfolio, a quarter of it, and rebalance it every quarter.
Okay, so that is our last slide. We can stop there.
For you, and you probably won't like it, but nonetheless, I'm a Martian. I've just flown in, and this is the only thing I've ever taken. This little seminar here on investing. It seems to me you just described the entire reason of why I want to go invest my money in passive index.
Only if you're worried about inflation, Harley.
No, that's the lesson. We were describing how much luck is involved in this thing, and you want to diversify to get away from this luck factor. Sounds to me like I'm an idiot in picking stocks, right? Which is the same thing as picking days, I suppose, when to start the process, your seed. So I should just put the money passively into indexes, and that's that. Isn't it the lesson over here?
So I would say the lesson is actually everyone who is active is implicitly a market timer. No one ever wants to admit to being a market timer, but at the end of the day, you choose when to buy and sell. And people might not have a reason as to when that choice is done, but that when really matters. So everyone is implicitly a market timer, whether they want to or not. My argument is not go passive. Be as active as you want, as active as you have confidence in. If you think you can pick the best 50 stocks, go and do that if you have high confidence in it. What I would argue is if you're continuously reevaluating that portfolio, what you want to consider is not buying 50 stocks and rebalancing it every December, right? Running your process in your screen and picking a whole new basket of 50 stocks. What I'm trying to suggest here is that you would want to rebalance it continuously, a little bit of the portfolio every month. And ideally, you know, how much of that turnover has to do with whatever strategy you implement. If it's a momentum strategy, you need to probably turn over a big chunk of the portfolio every week. If it's a value strategy, you can do a little bit every month. If it's a quality strategy, you can probably get away with doing a quarter of your portfolio every month. You know, again, with these option-based strategies, Harley, that you're all too familiar with, that convexity really adds a whole new element of risk when it comes to this path dependency. And that path dependency is really realized when you reset that choice of when. And so we're just trying to avoid that choice. If you don't have a good reason, diversify. But if you have a reason to not diversify, if you want to be active, go ahead and be active.
It also highlights dynamics that I think are typically underappreciated, which is flows into and out of a strategy, just like dollar cost averaging, can meaningfully affect the overall portfolio performance. If you happen to be in a fund that normally would rebalance on a quarterly basis, and that ETF or mutual fund, for example, receives a very sizable inflow in the middle of that time period, it's actually going to meaningfully change the performance of the strategy in total.
Right.
I mean, this is one of those things that is so interesting when you think about that dynamic of market timing, which Corey has correctly pointed out. By definition, an active manager is engaged in market timing. It's also really interesting to think about it from a single stock implementation. How frequently should you dollar cost average into a new buy? Should you think about it in terms of if timing is part of your model, for example, if you're using a technical analysis type approach, yep. It's often worth considering, am I creating value by simply putting additional capital to work? or am I actually adding value through the timing of my portfolio?
Right.
This is one of the ways of actually testing that validity.
Harley, I'll give you another great example here, I think, which is a lot of feedback I'm getting from advisors nowadays is they're interested in introducing alternatives to their portfolio. I think all of us on this call are probably proponents of a diversified allocation that includes alternatives, but they feel like they've missed the boat and they don't want to make a big portfolio change. You know, maybe they have a 60-40. They don't want to put a big slug of managed futures in today, or they don't want to put a big downside hedge in today because they implicitly understand, whether they can communicate it or not, that is a market timing call, right? The risk is they rode the 60-40 all the way down last year. If they happen to rebalance at the exact wrong time and the 60-40 recovers and they put alternatives in that underperform the 60-40, well, then they've got the timing call wrong in both ways. And so what I say to the advisors I work with is if you want to introduce a large change to your portfolio, you need to dollar cost average into it because that's diversifying your timing risk of when you do it.
Corey, I
So
agree with you completely that there's a, I guess we'll call it luck, and it does make a difference as to when you pull the trigger. Mike, you've done an awful lot of work on indexing and the key drivers, which seem to be millennials putting money in every 2 weeks or every 4 weeks, or not randomly, whether paychecks that drives things, and then boomers taking money out, driven upon tax stations. Is there anything that you've, reviewed in your work that would give us any kind of edge into when we do things?
Well, I wouldn't say so much in terms of when, right? I mean, there's the obvious dynamics of market timing of sell-in may go away, all those sorts of fun rules, the January effect that we all try to figure out simple rules of thumb that will position us well for those types of outperformance. Corey had highlighted the US election as one that has certainly played a role in the last couple of cycles. What I would suggest is actually there's a very different component to it, which is when you talk about putting money in, you're almost mechanically going through this process. So Mark Jacobs, for example, in his question said, use indices, but every 1/12 of a month. In fact, if you are rebalancing or allocating capital into a 401k, for example, where you're contributing every 2 weeks, you are implicitly doing exactly this, right? You are averaging across the start dates of portfolios to smooth out that experience. When you start withdrawing capital, though, it actually starts becoming almost even more important to think about the impact of volatility on your withdrawals. Because if you happen to take a withdrawal when the market is down 20%, let's say, your regular rebalance out date and withdrawal happened to be the day after the crash in 1987, you are suddenly selling significantly higher quantity at a lower price in order to generate the same income associated with it. So one of the things that you can absolutely keep in mind is that when you are putting money to work, these strategies work extraordinarily well. Ironically, when you're taking money out, it could work in almost the opposite direction. There could be some timing components associated with that.
Yeah, this is the
Why don't I
classic.
just sell every 2 weeks then? Wouldn't that be
What's
the same
that?
thing? Why just sell every 2 weeks?
Because selling actually volatility works against you, right? So dollar cost averaging, you're actually smoothing the volatility, whereas selling on a continuous basis, it actually works in the opposite direction. The volatility drag becomes larger as compared to smaller. So in many ways, you're much better off at least exploring the idea of taking irregular distributions and somewhat timing those distributions to market price action.
Not to get too complicated here, but one of the ways you can think about a withdrawal is that you actually just put on a short, right? So however much you wanted to withdraw from your portfolio, the equivalent action is you just shorted your portfolio in that notional amount. So withdrawals are sort of the equivalent of constantly putting on shorts, and it introduces this sequence of return risk. And to your point, the convexity elements are very different.
Right. Okay, so there's another question from Yves, Mark Cortines here. Would rebalancing continuously or daily approach the same math as tranching, or why not?
This is a great question. So rebalancing, again, so there's sort of two ideas here. Are you rebalancing 100% of your portfolio daily, which will be very different, or are you rebalancing a small chunk of your portfolio every single day, which would be very much like tranching? So A lot of the major quant firms out there have moved to this staggered rebalancing concept and will rebalance a little bit of their portfolio every single day to refresh which equities they're long and short to eliminate this risk. It doesn't happen in most of the major smart beta ETF products out there, but there are some of the more active quant equity funds, mutual funds that do exactly that. But again, the choice of when to rebalance or the frequency with which you rebalance is different than setting that frequency and then divvying up all the subsamples and rebalancing a little bit frequently across that.
And I just want to hit on that component in one other wrinkle, which is this idea of a continuously rebalanced market. You've highlighted this dynamic. Really what you're doing there is actually creating components that are very much like a delta hedging in options, right? When you, any time that you're engaging in a continuous rebalancing, you're effectively trying to approach the smoothness of the curve that would happen if of a truly delta hedged option that has that convexity component to it.
So I don't want to cut you off, but this is the perfect way to go back to that research affiliates example, because you know, you talk about value is just selling options. Well, if you go look at that research affiliates example, one of the big trades they made in March 2009 when they rebalanced was buying Bank of America. Bank of America from March 2009 through September 2009 went to go on and post anywhere between 10 and 20 percentage point returns every single month. You want to know exactly when it stopped? September 2009. So if you rebalance September 2009, you would have bought Bank of America, but it would have been after it already ran up. And so to your point, it is this continuous smoothing that you're doing, that dollar cost averaging into all these trades. Now, it would be great to say ex ante, I knew March was the way to go, but you don't. And so you don't want to take the risk as to which it is. And so it is, you know, dollar cost averaging is very much like that delta hedging concept.
They can actually mathematically be derived to show that they are almost identical. Okay, we are approaching the end of the hour here. I'd like to hit on a couple of other components that are kind of going on right now. Corey, you have come out and said something that I think is actually kind of important, which is this issue of not laying a fundamental or a market outlook down on print, because that changes the way that you actually think about things. As a quant, why do you care? What does it matter? Are you influenced by this?
I think we're all influenced by this stuff. So we were having a great discussion earlier today, maybe just to lay that a bit more on the table. We were talking about discussing your market views publicly. And I'm a big believer that whether you have market views or not, discussing them publicly can be psychologically damaging to your ability to change your view. Human beings like to remain consistent to what they say. It's just sort of a psychological, I don't want to call it a problem, but a cultural pressure we have. We don't want to seem inconsistent. And so when we express a view like inflation is transitory, we just won't back off. Once we've said it, we're going to stick with it no matter what the facts say.
And that's actually exactly why I want to introduce that, because Harley, you have an opportunity now to accept that inflation is transitory, or perhaps I could take the opposite side of the equation. What are you thinking these days, Harley?
I think the inflation is going to go down. It's not going below 4% this year. The Fed's not going to go and cut rates this year.
So now I think that is certainly the Fed's intention. I actually do think that inflation probably will move below 4%, particularly if we use metrics that exclude the very stable housing component, right? Like if you were to isolate to the non-housing or OER components, which you know is exceptionally slow moving, would you change your point of view?
I'm more interested in wages and the demographic of millennials working and spending and boomers retiring and working less, and then of course immigration policy. So you have a shortage of labor, and people are going to have to go bid it up. I mean, people are going to argue right now that we had a 500 and change number, but it doesn't count because if we unseasonably adjusted, it was negative 2.5 million. I noticed that when the other way around, when we have a massive negative number, but it was the season was the other way, that no one cries about that. So there's always cherry picking going on. I mean, CPI less everything is zero. I think we have a labor issue here, and that's going to support services. It's hard to get people, and and the Fed's not going to back off because they're kind of they box themselves on in. And
Harley, I'm curious as to your take. You mentioned the seasonality effects of the jobs report, right? If we look at December, I think there was generally less hiring, seasonal hiring of people in Q4, which means in January there's less seasonal firing. Isn't that sort of a perennial risk of full employment? Just when there's full employment, you get less of those seasonal effects, and that's something that we have to potentially consider going forward.
This is, truth be told, it's above my pay grade. I just don't dig that deep into these things. I suppose they're interesting, but I mean, the number is the number. We use seasonals for a reason. And 3.4, if you want to say that that's also a rigged number for various counting, okay, maybe it is. But I mean, 3.4 unemployment, you're getting down as low as you can get on this stuff. And that kind of indicates if you want to get someone, you're going to have to go and pay them more money to pull them off the couch, or pay them more money to get them to change jobs, which doesn't seem to me like a situation where you're going to have service costs, wages going down or anything like that. We'll find out how it plays out. I mean, the bigger concept to me really is we could haggle about transitory or not, and what we've done if we'd invested in 30-year zeros like some of our friends had suggested when Mike was talking transitory. That's down a lot now, Mike. But I mean, let's just say that how long can this curve stay inverted like this? Unless the Fed really jumps in and starts cutting rates tomorrow, how long can we run a negative, 100 basis point spread, 2s, 10s? Because it's costing a lot of money for people to be invested in the back end. And my view is that what you're going to see going forward is sometime, somewhere, the curve's going to rotate around the 5 or 7 year point. When that happens, I don't know. But this is why the strategies that we offer about a levered front end paper, I love those things because I think we're kind of topping out on the front end, and I'm pretty sure that's going to come down. Whereas the back end, unclear what that's going to do.
Yeah, I think that's actually really interesting. I would highlight to your specific question, Harley, if you actually look at the forward curves, and I'll try to send this chart out over Twitter, but if you look at the forward curves, we're actually starting to see forward curves. In other words, 1 year out, 2 year out, in terms of what the curve is supposed to be according to swap rates in another year. We're starting to see those uninvert, particularly in things like 5s, 30s, et cetera. Those are now offering positive yield curves. At least they were prior. I haven't seen where
that's just bond math. The more you invert the curve, the bigger the forward curve is going to be steep. I mean, this is not a great revelation. It's just discounting.
Well, let me rephrase that then, because when we're talking about the forwards and we're talking about those dynamics, that's not actually totally true, right? Yes, it's bond math that there is that component to it, but the forwards invert before the spot does. The forwards uninvert before the spot uninverts. And that's absolutely what we're seeing. So the process is beginning. I'm sorry, say that again.
Before the forward curve is just the discounted spot curve. There's no magic over here. It's not a prediction of anything. This is what it is.
I think this is actually going to be the interesting component, because the dynamics of what you're highlighting in terms of is the Fed going to cut, the reason that I'm saying actually that I'm not as sure that you are correct on the Fed not cutting. I agree the Fed has no intention to cut. The question is, how does the economy develop over the rest of the year? Does that actually force conditions? Do we see the proverbial financial conditions tighten in a way that causes the Fed to be forced to loosen? I think that's going to be the interesting question. It's not what their intention is. In the same way, in 2021, they indicated that their intention was not to hike for several years. Right. So, this is an institution whose forecasting is only slightly better than mine. When you look at those underlying dynamics, you have to really, the real question of what you should be fearing is, why is the Fed going to cut? There's a positive story behind it. Does the Fed ultimately end up solving for a soft landing? Do we mute the inflationary dynamics? I got to be honest with you. If the current forecasts for no landing or soft landing are right, I have to agree with you, Harley, that we are not going to get below 4% on inflation. And actually, I would suggest that there's very real risk that will be much higher going forward, because we haven't seen the investment to smooth out the supply chains, replace China in the supply chains, et cetera.
Yeah, I mean, like so much of this stuff is always a matter of there's the economics of the process, there's the ego of the process, and the Fed certainly has an ego, their own, to manage right now.
I think that's going to be that for me is really what is quite interesting, because we're now in a situation, you can see it on Jerome Powell's face when the market goes up. It's like he's eating a lemon, basically, right? He's not at all happy with what he's seeing in terms of the behavior. Well, we can actually hit on that next month. I believe that we have Lacey Hunt back. Is that correct?
That is correct. Mike, you keep stealing my job from me. I've got like one job and you're taking it from me.
This is 2023. It's recessionary conditions. Everybody's announcing layoffs. Brian, I'm sorry to inform you. Anyway, we're going to wrap up on our side. Brian, take it away from us.
All right, thank you everyone for joining us. Mike was correct. Next month, we are welcoming back the legendary Lacey Hunt. So please be sure to register. For more information on Newfound research, please visit thinknewfound.com. For more information on Simplify and our strategies, please visit us at simplify.us. Everyone have a great evening, and thank you again for joining us.